they're serious about becoming, they've chosen that for their career. It's something they're committed to, and they want to get better, and they have an ambition to build a real estate business that requires them to raise capital from investors on an ongoing basis, then I would say my answer would be similar to, the Chinese philosopher that was asked when the best time is to plant a tree.
Mm-hmm.
His answer was,
right now.
20 years ago.
Yeah.
But the second best time is today.
Right.
So if they really are committed to that, then, we feel like we can help them understand what it takes to become a successful real estate entrepreneur. I always answer about that real estate, it's not a single market. It's a collection of a great deal of micro markets, right? There are different geographic regions, different sizes, different categories of assets, and then subcategories of assets, right? So retail or multi or storage or industrial or office, or and then each one of those you'd have class A and class B, and you have gateway markets and secondary and tertiary. So there's all kinds of sub-markets. So there is no broad answer to that question. But if I just the simplest way I think to look at it, if I broke them down by category broadly, multi-family, I think is going to hold up very well. Again, pockets, some things will be hurt worse than others. Perhaps some class A, very expensive stuff that was getting built that had crazy rent growth assumptions that probably don't happen now gets hurt. But, a class B or C in a suburban market for a, workforce type housing, I think holds up incredibly well. I'd say frequent. We ate dinner at home pretty frequently. My parents and my brother and sister. Grew up in California, kind of middle class household, and talked a lot of sports.
Yeah.
Talked a little bit about life. And
what were the favorite teams growing up?
Even though I grew up in California, I was a Minnesota Vikings fan.
Okay.
Strangely, just like the purple uniforms. The Los Angeles Dodgers. I grew up in Southern Cal, so the Dodgers were my baseball team, and the Atlanta Hawks were basketball because back in those days TBS was the only live basketball you could watch.
Yeah, that's great. Are those still the favorites today?
Certainly not the Hawks.
Yeah.
I live in Portland, so I like the Blazers more than the Hawks. But Minnesota, yes. And baseball, I don't. I've kind of lost interest in really following baseball. If I had to pick a team, I'd say it's the Dodgers, but I really don't care about it much.
Yeah, very cool, very cool. So growing up, obviously you have a great entrepreneurial past. Growing up, did you have any jobs or anything like that you started yourself? Were you the kid that was selling candy, or did you have kind of jobs that you started as a kid?
Not really. No, I mean, I certainly worked, but I'd say they were more kind of traditional, jobs here and there. Mm-hmm. And I'd say for me, I didn't really contemplate, actually starting my own business and becoming an entrepreneur until I was probably in my early 20s. So yeah, no, I wasn't one of those people that, from the time I can remember, set up my own company.
Mm-hmm. Excellent.
Trying to get my son to do that, but
yeah. What are you trying to get your son to get into?
Well, he's doing it on his own, but he's doing a little power washing business and kind of washing driveways and decks and such for people in the neighborhood.
Yeah, very cool, very cool. So talk a little bit about what made you make that transition. What made you make the leap into wanting to be an entrepreneur? In your 20s, were you working for someone and just felt you could do it better, or what was the catalyst for that?
Well, the real catalyst was that I moved to Portland from California in 1991, and to open a branch office for it was a financial services company in Portland, which was their second out of California office. And a year after I moved up here in the early 90 S&L crisis, they closed down the vast majority of their offices. So I was freshly in Portland, and the company closed up. They offered me a job to come back to California and collect loans and that kind of thing, but I didn't want to do that. So it was either find a job or, I had sort of contemplated that I might want to do something on my own someday, but the circumstances kind of foisted upon me, and we sublet the space that I had spent several months negotiating on behalf of the company I worked for. We bought the brand new furniture that I had, went out and bought for the company for about 10 cents on the dollar. And I borrowed 10 grand from American General Finance Company at 21% interest and bought a computer, and we were in business. So
that's great. That's great. And was that Fairway at that point, or?
Yeah, it was the original name of the company was Fairway Financial Services Inc. But yes, it was Fairway in 1992.
Wow. So you've been doing that quite a while. That's great.
Yeah, 28 years.
Yeah. So what was when you hung your shingle as Fairway, were you basically doing the same thing that you're doing today, or have you shifted a little bit over the years?
Oh, we've shifted. I mean, we've grown and shifted enormously over the years. Yes. I certainly cut my teeth doing what we were doing then, but it's what we do today is much more sophisticated and complex. But it's all real estate finance oriented. So,
and talk a little bit about what you do at Fairway today.
We're really a co-sponsor of real estate deals. So we provide an element of the infrastructure that a real estate sponsor needs to have, but oftentimes can't build out internally, and combine with them to effectively do real estate deals in the middle market space. So we're involved heavily in the capital structure, the capital acquisition, the underwriting of the transactions, and then ultimately the investor relations work. So a lot of the back office capital side of the equation. And our sponsor partners, co-sponsors, do a lot of the front end work. So they'll identify the property, negotiate the sale, hire the construction, do whatever work is necessary, do the leasing and the management of the property and all of that.
Got it.
Combined, we allow investors to really get into a fragmented space, which is the sub-institutional size, below the radar of the really big institutions, which is very fragmented, very inefficient, and there's a lot of opportunity there, but it's hard for institutions to penetrate down into that size range.
Got it. So who would be your ideal type of client? Who would you want to have come to you?
Well, it's a kind of a dual-sided platform, Matt. So there's, on the sponsor side, it would be a local or regional real estate professional who acquires commercial real estate projects of one sort or another, acquires and manages them and owns them, and runs them for a profit. So it's maybe a mid-sized group, anywhere from 5 to 20 employees. In any major market in the United States. So it's a nationwide platform. But there are really high quality and high caliber real estate professionals in basically every market, and in that middle market space. And people who they haven't reached enough scale and size that they've built out the internal, the vertical integration of the capital market side as thoroughly as they would like. So that would be an ideal sponsor client. On the investor side, the dual-sided platform, the ideal would be a family. There's a range of investors, from the high net worth investor, accredited, putting in a few $100,000, all the way up to very institutional investors putting in tens of million or more. But I'd say the ideal would be a family office, with a sizable net worth that wants to be involved in the real estate space, but doesn't have the infrastructure to go out and identify those sponsors directly themselves, and can use a group like ours to help them access that product.
Got it. So what type of structure do you use when you're putting these things together? Are you guys coming in as preferred equity, or what types of things do you typically put together on most of the deals that you do?
It's a variety of structures. I mean, we've done a lot of pooled funds where the investors are coming into a vehicle and they're providing the manager with discretionary authority to decide which deals to acquire, within the framework of some investment mandate that's specified up front in an offering memorandum. Or we'll do them on an individual basis where you're matching one or more investors to a specific deal or transaction. So anywhere from that would, I'd call that a syndication. So we might find a single investor or multiple investors to come into a one-off syndication, or in some cases we'll form specific investment vehicles around a certain strategy where they come into a pool and allow the manager to have discretion over the acquisition and disposition of those assets. So it varies depending on the sponsor and the investor.
Got it. I mean, what are some of the common mistakes that you see people making when they approach you? What would give them the best chance to have you want to do business with them, I guess?
It's really all over the map, Matt, in terms of where people are in the progression of their business. But I would say there's a misconception on the part of many small and middle market real estate people around what a fund is and means. A fund is aspirational, right? Because it allows the real estate entrepreneur to have discretion over which deals they're acquiring without having to get the investor's specific approval for every single deal. Mm-hmm. Now, the latter becomes very cumbersome if you're doing any volume of deals, right? You got to get somebody to say yes for every single transaction, mm-hmm. as opposed to if you put a fund together and they come into that fund, they're putting the money in, and then you have the money there to go out and make the decisions without having to get their approval on every single deal.
Yeah.
So a lot of people want to set up a pooled investment fund, but I would say if I had this is a broad generalization, but that would be probably the number one thing that I think people are either confused about or don't understand as well, that somehow magically if you set up a fund, then the money's there, mm-hmm. and now you've got the money to go make deals with. And reality is it's probably harder to raise money in a fund because the investor's not picking and choosing which deal they're putting their money into. Mm-hmm. Mm-hmm. Right. So that's probably the number one misconception I would say exists with sponsors.
Got it. And so basically you sort of are the middle person there that's filtering out all of the different deals, and you're basically qualifying the deals that you would utilize the fund's resources to invest into it.
Yeah. I mean, it's a bit nuanced for sure. And frankly, sometimes it's hard for us to, accurately describe to one side or the other of this dual-sided market, exactly what it is. And mm-hmm. I think people will confuse us from time to time with, like, what are you? Are you a sponsor? Are you a placement agent? Are you an advisor or a consultant, or, what are you? And it's like, well, we're a bit of all of the above. But if I had to say, what I believe the value proposition is that we bring to the table is for the sponsor, it's doing the parts of the business that they like the least, and they generally have the lowest skill set in, which is the capital structure, the raising the money, the investor relation, the back office, the accounting, the admin. Real estate people generally, they just want to go do real estate. They want to go kick the tires, kick the dirt, look at the property, negotiate the deal, hire the contractor, do the leasing, sell the property, and move on. All the other stuff that goes along with it is not their favorite part.
Yeah.
So we bring that to the table for the sponsor. For the investor, it's a different value proposition, and particularly for the institutional investor, they just won't come down into the middle market space all that often, if they're dealing directly with the sponsor, unless that sponsor is fully vertically integrated and is institutional enough that they can justify dealing with them based on the amount of time it takes,
Mm-hmm.
to underwrite something. And that pretty much means then they have to be of a certain magnitude and size to even have a conversation in the first place.
Yeah. Yeah.
Because they're just not going to come in and write a $5 million check or a $10 million check. If it's not 50 or 100, they don't even want to talk to you.
Mm-hmm.
So for the institutional investor, we enable them to come into a market that generally can produce higher returns with less competitive pressures from other institutions in a way that they can feel comfortable with, because we bring that vertical integration to middle market sponsors who aren't far enough in their progression to possess it themselves, right? They don't have either the expertise and there's a lot of overhead, to hire all those people.
Yeah. Yeah.
So I don't know if I answered that well,
Yeah.
but
No,
that's what I
absolutely.
think is the value that we bring to either side of the aisle.
What would you say is the minimum type of project? And so I mean, you mentioned before, there's all types of different projects. I mean, obviously there's commercial, there's retail, there's
Mm-hmm.
multifamily. I'm assuming you play in all of the above.
We do.
And what would be the minimums that you would look at for these types of projects? I guess minimums and maximums.
Yeah, I'd say it'd be a bell curve, Matt. So on the low end, we would certainly look at something for $1 million,
Mm-hmm.
or if the total check size was probably as low as $500,000 or $1 million or $2 million, we would look at it. On the high end, and that this number is increasing as we continue to gain more traction in the institutional space, but 50 or 100 million.
Okay.
And I'd say 5 to 25 million would be where the peak of the bell curve would be.
Mm-hmm.
The most sweet spot would be there.
Mm-hmm. Yep, that makes sense. What would you suggest to people that are looking for this type of help? Again, I'm what a lot of people struggle with that I've seen is, basically reaching out in a way that, gets your attention. Is it pretty well where you'll look at every deal that comes across the table, or is there a way to be able to present it in a fashion that, sort of piques your interest a little bit more, if that makes sense?
Yeah, it does. But I would say for us, we have another business called Veravest, which is a fund administration company, and it has other ways that it provides value to the entrepreneurs and sponsors that are particularly on the smaller end. People that are just starting out or aren't quite as built out yet.
Mm-hmm.
So if somebody inquired with us, we generally will get back to everybody very quickly. On the investment side, if they're looking for money, which most of them are, it's got to be sizable enough to justify the time it takes to underwrite somebody, which is time consuming, especially the first deal, right? You've never done something with somebody, it takes a while to get to know them. And if there's time pressure, they've got it under contract and they got to close in 30 days and I've never heard of them before, the chances of us getting to the finish line, in that time frame are pretty low.
Yeah.
Depend if it's equity. If it's debt, we can do that very quickly, because there you're just lending based on the value of the property, and you don't have to do as much homework. But if it's on the Veravest side, I'd say that's more of a consulting engagement where that business is designed to try to help people understand how to develop better capital structures, how to make themselves more appealing to investors generally.
Mm-hmm.
And I'd say particularly for newer, younger, less developed companies, I feel like Veravest has a great deal of assistance to offer them in terms of just not necessarily giving them capital, but helping them understand what it takes to attract capital, whether it's from Fairway or anybody else, right? So, we're very, I like to think we're very approachable around there's a variety of ways in which we can engage with somebody to help them depending on where they are. I mean, one of the phrases I use is, we try to meet them where they are.
Mm-hmm.
That
Yeah.
doesn't mean we can do something for everybody, but we'll at least explore it. And if there's a mutual fit, we'll try to help them. If there's not, we'll be very upfront and tell them as quickly as possible that it's not a fit and try to point them in the right direction if we can.
Yeah, yeah. So you kind of touched on some of the timings there as well. So at what point would you suggest someone reach out to you? Obviously, this is probably just like any other real estate transaction. It's very relationship based. So at what point should they reach out and start making that relationship? Obviously, if they already have something under contract, it might be a little bit too late. Is there a step that you can suggest that they would take, prior to having something under contract, or you basically want to have something under contract first before you would?
Well, I would encourage them to reach out to us even before that, particularly because there are other ways, Matt, that we could help them besides just giving them money, right?
Mm-hmm.
So if they're serious about becoming, they've chosen that for their career, it's something they're committed to, and they want to get better, and they have an ambition to build a real estate business that requires them to raise capital from investors on an ongoing basis, then I would say my answer would be similar to, the Chinese philosopher that was asked when the best time is to plant a tree.
Mm-hmm.
His answer was,
right
20 years ago.
Yeah.
But the second best time is today.
Right.
So if they really are committed to that, then, we feel like we can help them understand what it takes to become a successful real estate entrepreneur. I mean, there's a lot of groups out there that can help the kind of, the person that's working at the company and, buying or flipping houses on the side or doing small notes on a one-off basis in their IRA account or something. That's not really the kind of person I'm talking about. I mean, we're talking about people who this is what they do for a living. They have their own business or company, and they're buying property, they're making loans, they're acquiring distressed debt, or whatever their strategy is, but this is their job, their company, and they have to raise money from people on an ongoing basis to be successful. That's our target audience.
Got it. That makes a lot of sense. Can you, obviously we're sort of just coming out of the, the Black Swan COVID event. Can you talk a little bit about what you're seeing on the real estate market now because of that event?
Yeah, I think it's even before COVID, I would say I always answer about that real estate, it's not a single market. It's a collection of a great deal of micro markets, right? There are different geographic regions, different sizes, different categories of assets, and then subcategories of assets, right? So retail or multi or storage or industrial or office and then each one of those you'd have class A and class B, and you have gateway markets and secondary and tertiary. So there's all kinds of sub-markets. So there is no broad answer to that question. But if I just the simplest way I think to look at it, if I broke them down by category broadly, multi-family, I think is going to hold up very well. Again, pockets, some things will be hurt worse than others. Perhaps some class A, very expensive stuff that was getting built that had crazy rent growth assumptions that probably don't happen now gets hurt. But, a class B or C in a suburban market for a, workforce type housing, I think holds up incredibly well. Industrial, I think, benefits ultimately from COVID. A lot of repatriation of manufacturing from offshore, a trend toward warehousing more inventory rather than relying on just in time because, in a case like this, it's gone. So I think industrial does well. Office, there's a lot of mixed feelings about what happens to office going forward. So I think the jury's out on office. I have my personal opinion and so do a lot of other people, but I think you probably see the widest disparity of opinions in that asset class. Retail, I think, is going to go through a fundamental metamorphosis over the next 10 years or so. as more and more goes online, and malls struggle, and you're just going to see a lot of repositioning. So I think you're seeing a systemic sort of fundamental change that will be gradual and slow in retail. And it's obviously been hurt badly with the mandatory closures of a lot of businesses that are in these retail. I mean, there's been a trend toward experiential retail, away from, these big box, try to be everything to everybody type facilities. And that's just being accelerated now, right? And then hospitality, of course, has gotten hammered the worst in the short run, but I think that'll bounce back once people can start traveling again. And I mean, it'll have a deep dive, but it's not going through the same fundamental shifts that retail is, in my opinion. So, it's super interesting to see some benefit, some get hurt. There's going to be situational opportunities, in my opinion, that sometimes will have nothing to do with the property and everything to do with this, situation of the owner of that property, who's in a position where they're forced to sell. So I think you're going to see over the next several years a lot of buying opportunities at prices that just flat out didn't exist in the last 6-7 years, when everything was just going up and up and up.
Yeah.
So interesting times to be sure.
So in your, because you've gone through a couple of these types of cycles now, in your opinion, is there, you kind of just touched on it a little bit. Do you think that there's, and of course nobody can predict the future, but do you think that there's a window where, you're really going to start seeing a lot of those opportunities come to the market that, weren't there certainly, 6 months ago, but how long does it take? And again, this is a very, very unique situation, but how long would you feel that it would take before you start to see a lot of those types of opportunities? Is it, a year? Is it 3 years? Is it, any thoughts there at all?
Yeah, I do think it depends on the asset class. I think you'll see more opportunities more quickly in things that are getting hurt the worst. So hospitality, there's already, blood in the water in a lot of cases, and you're seeing things come to market. Although, the reasonably well-capitalized people are able to hang on because they're getting a lot of forbearance from lenders and things like that. But I think you'll see that the fastest. Retail, I think you'll see opportunities in the next year or two, as you will in office. I think short run, there'll be a few opportunities in industrial, but I don't think it's going to get hurt as badly. I think unlike the last downturn, there was a lot of fundamental weakness in the economy. Now it happened a lot more slowly, and so you could kind of see it coming a little bit more than you could this time around. But I think this time you're going to see more situational distress where, people are forced into a position where they have to do something, sell the property when they really don't want to in a buyer's market. But I think it's going to be less, with some exceptions, I think it'll be less predictable as to where that's coming from. So I've had a lot of people ask me, you think it's, worse or better, or more deep or not as deep as the last time around. I think it's probably be as deep or deeper, but different in terms of just how it came about.
Yeah.
It was sudden and rapid in this case. And the last one was more systemic and slow.
Yeah, that makes sense. So you've also authored a book, Capital Attraction. Can you talk a little bit about why you wrote that book and who that book is best for?
Yeah. I wrote it to the target audience I described a few minutes ago. The person who is committed to running a real estate asset-based business that acquires real estate assets, whether that's directly owning the property or owning the debt against the property, that requires that person to raise capital from investors and manage that capital on their behalf and do that on an ongoing basis. That's kind of what at the time I defined that as, a small balance real estate entrepreneur is someone who runs a real estate asset-based business that requires them on a repeated basis to have to go raise money from others. Then the bigger you get, the more you have to raise money from people you don't know. How do you go out and do that on a regular basis if you're not an institutional size shop? That's the target audience for that book. And I wrote it largely, Matt, out of my own experience of, because I am that guy, right? I mean, that's what I did when I started the company. We started raising money from private investors to put them into real estate loans,
Mm-hmm.
and matching them up one at a time, and eventually starting a fund. And, all that learning and all that experience, and, the battle scars that you go through in doing that, and all that I've learned of just trying to help other people understand, at least as best I can, what that means and what that's like. And that's who the book was written for.
Got it. That's great. That's great. So Matt, this has been fantastic. If people want to learn more about you or your services, what would you say the best way to learn more about that is, or get in touch with you?
You certainly go to our website, which is fairwayamerica.com. You can certainly reach out to me. What I'll end up doing is passing you to Kellen, so I'll maybe give you Kellen. But Kellen's worked with me for close to 15 years now. He's our director of strategic accounts, and he's kind of the frontline guy on working with new sponsors and entrepreneurs. And his name is Kellen, Kellen Stevens, Stevens, at fairwayamerica.com. And Kellen and I work real close together, and he'll respond very quickly. So
love it.
So go to the website and reach out to Kellen.
Perfect. I appreciate this, Matt. This has been fantastic. It's always interesting hearing people who have been in the business for quite some time, and hearing their experiences and how they've shifted and grown over the years. So really appreciate it.
Yeah, my pleasure, Matt. I appreciate what you're doing, trying to help people understand the entrepreneurial journey and all that. It's been near and dear to my heart. And I'll give a quick plug for one of the things that's helped me the most over the years. I joined a group called Entrepreneurs Organization. I don't know if you're familiar with EO.
Yeah. Yep.
It used to be YEO, Young Entrepreneurs Organization, until everybody got too old and they had to drop the Y. But that's where I've learned a great deal, and probably the organization that's meant the most to me in terms of helping me deal with the whole entrepreneurial journey. So I admire what you're doing, and I appreciate the opportunity to be on your show.
I love it. No, I appreciate it. Thanks, Matt.
All right. Thank you.